Santosh tells Rajesh that he has a lot of money stuck in the stock market and all of the money he had invested in IPOs for the last 2 years have sunk. Rajesh asks him, where is the money invested? Santosh tells him that he has invested money in IPOs like LIC, Paytm, Nykaa, Delivery and Cartrade Tech. But he says that the condition is bad and the money is stuck in each of them. Rajesh tells him that he had also invested money in these shares, but had earned good profit out of them. This makes Santosh wonder that how did this happen, as he had lost in the same shares while Rajesh made profit. You might also be surprised that after all, how did Santosh's money drown, while in the same type of shares, Rajesh benefited. So the basic thing is that Santosh had invested money through the primary market, that is the IPO, while Rajesh had invested in the secondary market, that is after the listing of shares. But still the question remains, why is there such a difference in returns from the strategy between Rajesh and Santosh?
I think the reason behind is the efficient market hypothesis. Whenever a company which is coming in the primary market, when it trades into the secondary market, lots of volume is coming and people are valuing that company. While in the IPO, there are no such volume is generated, only a fixed price or a band of price is given. Beyond that, nothing is available. So you are investing at a certain point in time. But in market, whenever a company trades, you are getting the valuation by the market, or you can say it is a collective market valuation which it is giving to the company. So that is why a market is quite efficient to value any company at any point in time. I think the efficient market hypothesis is the only one reason why the secondary market is more liquid and it can value a company very prudently. And that is why the reason is whenever IPO comes at a higher valuations, people have a kind of you can say a feeling that you can left out and you have invested at a very higher valuation. But whenever you are there in the market trading the same company, you are getting a reasonable valuation valued by the market. And that is why so many people, when they come to market and invest in any such company, they are able to make profit.
Actually, there is a better price discovery in the secondary market than in the primary market. There is also a reason that the results of 1 to 2 quarters or a year before the IPO are shown to be excellent, but after listing, most of the companies are not able to continue the pre-IPO performance in the results. Apart from this, the share price is also affected by the impact on the growth of the industry due to the challenges of the sector or the economy. That is, investors now need to be sensible in the primary market as well. The investor of the primary market is considered as FD Wala, that is, a gullible investor who used to earn good money from IPO by taking opinion from someone or on the basis of hearsay. But many IPOs listed in 2022 fell below their issue price within 1 week of listing. Similarly, if we talk about the whole year of 2022, then 43 out of 100 people who invested money in IPO have suffered losses. Out of 40 investors in IPO, 17 made losses and 23 made profits. Out of the 40 IPOs, 15 were below the issue price, 2 were absolutely flat, and 23 were above the issue price. If we talk about the year before that, that is 2021 as well, there was a lot of discussion about IPO of many new age companies like Paytm, Cartrade and Fino Payments. Their shares were listed at a very high valuation which later collapsed, especially Paytm stock, which fell by almost 40% within 1.5 months of its listing in November 2021. A major reason for this can be considered that the valuation of these companies was greatly exaggerated. Most of the companies were such that there was no trace of profit. The business model is such that there is no assurance of when the profit will be received in future and whether it will be received or not. Out of the total 65 IPOs in 2021, Only 45 have given positive and 20 IPOs have given negative returns. But still, for an investor, IPO, that is primary market, is an easy entry in the stock market and a good opportunity to become a participant in the company from the initial stage. So, if a retail investor has to invest money in the IPO, then the question arises, what things he has to take care of or what should he look out for to invest in an IPO?
See, the investors should be enough cognizant about these certain facts, like what the company does, whether the product which the company dealing with or manufacturing is reasonably good, and there is a market about that product in the market, and again you can see the valuations about a company, at what value the company is offering you the shares. These are the things I think you should look. And apart from this, you should look at the prospect as well. Go to the red herring prospectus at SEBI website or the exchange's website. From there, you will get to know about the industry, what the company does, and who are the peers about the company, and whether the company price is reasonably valued. These are the things I think one should look for.
It is also important to see what kind of business the company is in. The company should be a part of a growth industry. That is, instead of a cyclical one, it should be part of a continuous sector like FMCG, pharma, healthcare, food and beverages, power, et al. Also see whether the company is debt-free or not, as well as corporate governance should be good. There is no litigation going on against the company or the promoters, and also make sure that in the coming times, how are the company's prospects? That is, how much is the possibility of growth?
See, whenever you are stuck in an IPO and invested at a very high price, you should look about the fundamental of the company, whether that the fundamental is reasonable or whether that fundamental or the numbers are declining or rising. Whenever the numbers are declining, it means company is not able to make profit, and that is the point you should come out from your investment. Otherwise, if there is any such numbers which are coming every quarters, giving you the kind of hunch that the fundamentals are turning around, and then only you should average your IPO investment.
So what is the biggest lesson of the IPO market? The biggest lesson is that if you're not a quick decision maker and you don't speculate, meaning if you don't decide to sell the shares on the day of listing or within a week, then you should invest money in a secondary market, that is after listing, and see the results of at least 2 quarters. And if the company's results are not improving continuously, then you should understand that the time has come to get out of that stock. So remove this illusion that every IPO is an opportunity to make money and listing in it, and that you should invest blindly after seeing all the noise before listing. If you do a little hard work and research, then there are many opportunities to make money in the secondary market too.